Healthcare, healthcare, healthcare. Healthcare in America has been a hot topic, and I've discussed this in my first quick dive video about United Healthcare. As the whole industry is affected, another company caught my eye, Centene Corp or CNC. CNC hit my watch list after dropping more than 40% in just a day. This came after their announcement of pulling guidance similar to other health insurers. This company caught my eye because of their potential to be a deep value investment. Are they really deep value or are they just another value trap? Let's find out. At the point that CNC hit my watch list, I have already purchased United Healthcare but have not compared their businesses to each other. After looking into Centene's annual reports, I like the company as they are differentiated from UNH. They lead the widest demographic of health insurance customers by being the largest Medicaid provider while also focusing on their insurance marketplace. This means that if I were to invest in Centene, my exposure would be in the largest Medicare and Medicaid insurers in the USA. Additionally, they have also divested their PBM business in 2022, which is a segment that is heavily affected by regulatory risk. This is luck in the case of Centene as their divestiture was due to legal problems during that time, paired with that segment not being part of their core functions. Now, to dive deeper into their numbers, what is noticeable is how large their liquidation value is compared to its current market value. At the time of making this video, their liquidation value was 55.47% higher compared to their market value. This means that if you were so rich and you were able to buy the whole company, you could potentially have a 55.47% upside when you liquidate it. Of course, there's a chance that the value would be lower, but I am not an appraiser of assets. So, as an investor, I chose to stay conservative and assume that this is the largest upside you could get. The company was looking amazing at this point, but I still had to assess if the company can at least maintain its future earnings. So, what factors did I look at to assess this? I focused on their 7-year average owner earnings and growth to stay conservative in my estimates. After my computation, it's crazy to see how undervalued the stock is if I assume that they can keep their future earnings intact. Their 7-year average owner earnings of about 2.37 billion shows that you could potentially make all your money back within 8 years if the company does not grow. To put that into perspective, that is just about half of their year's most recent earnings. This means that if I assume that they can maintain their most recent year's earnings, you could potentially get your money back in just 4 years. That is an insane deal to me, but of course, I will stay on the conservative side. Next, what gives me confidence that they can maintain their future earnings and growth is management's focus on their core functions while also adjusting their cost expectations for 2026. Additionally, as they are the largest provider of low-cost insurance, which is basically a need, I'm confident that their proposed rate adjustment will at least let the company operate profitably in the coming year. With that, I see CNC as a deep value investment rather than a value trap. After learning all this, I have decided to buy the company's stock. You might wonder why I did not do a relative analysis before this purchase, but my reason is that the company fits my deep value investment criteria. When a company is in deep value territory, my analysis focuses on the individual company, or as some call bottom-up approach, and may require additional research to be confident in it. In my perspective, Centene did not need any additional analysis. I already have an understanding of the industry's landscape due to my UNH research, and after looking at the company's fundamentals, my confidence was immediately off the roof. Additionally, their position as being the biggest Medicaid provider, mixed with their insurance marketplace, gives me confidence that they can retain their future earning power. But for the sake of showing the comparison, here is my relative analysis for UNH in the view of Centene. As you can see, they have the lowest operating ratio paired with negative free cash flow. This might seem very negative at first, but this is due to working capital changes within that year. What caused this is their premium and trade receivables increasing significantly for the period. That means that the company has not realized a chunk of their receivables by the end of the reported period. This is not something to be afraid of, as they do receive their premiums within the month of providing their service. Instead, it should be understood that their premium and trade receivable line shows how elevated their services have been since the start of the year. As you can see, there has been an increase of more than 80% for the first half of the year. On the other hand, what really caught my eye here is their solid return on equity paired with having the second best medical cost ratio. Those ratios show how management manages expected cost. As for the unexpected costs this year, I expect that this is not a normal occurrence, hence unexpected costs, if you look into their last 7 years of data. With that, here are my purchases of the company's stock. From these purchases, I have a cost basis of $28.15 per share. As my cost basis is below current prices, my steps moving forward are a bit different when compared to my Crocs investment. As it is a deep value investment, I plan to hold this as long as the company's quality stays intact or sell the stock if an opportunity arises. This opportunity can only arise if 1. There's an amazing high quality stock that has a significant margin of safety, or 2. The company's market value is at or above my intrinsic value computation. To end my analysis, here's a quote from Warren Buffett's mentor, Benjamin Graham. An investment operation is one which, upon thorough analysis, promises safety of principal and adequate return. Operations not meeting these requirements are speculative. Thank you so much for listening to my analysis. For those who are curious about my portfolio updates and changes, please don't forget to like, comment, and subscribe. I will be doing this for future videos as well. Thank you so much.